Hey guys, welcome to Our Financial Future. This is a channel designed to build a community of investors so we can all reach our financial freedom. In this video, I am going to go over what a balance sheet is, what each line represents, everything that you need to know inside of it, and stick around till the end because there's going to be an important calculation that you need to know. So let's get into this. A balance sheet represents a company's financial position on a specific date. This is very important information to know for a company's financial health. There are three important parts to the balance sheet: assets, liabilities, and shareholders' equity. Assets are essentially what the company owns expressed in a dollar amount. Liabilities are what the company owes out in money to creditors or possibly suppliers. Shareholders' equity is what would happen if you turned the whole business into cash and then they paid off their debt, and what was left over is shareholders' equity. So we're gonna go over to my computer and check out what a balance sheet is. So let's get into it.
Hey guys, so what I see around on the internet is a lot of people using Yahoo Finance, and the reason I don't rely too much on Yahoo Finance when it goes into evaluating companies is because they don't put in all the information. And you can see here where it says total cash, net receivables, and inventory. If you added up all those numbers, it actually only equals 428 million. So they're actually missing some numbers here. And if you go over to Morningstar, you can see they've added the lines that they are missing to get the proper total of 500 million. Top left-hand corner here in Yahoo Finance, you'll see the number says thousands. So that means all these numbers here are actually millions, where I like to use Morningstar because it says millions up here in the left-hand corner. So it makes these numbers a lot easier to read. This is a company called Enphase Energy, and at the top here you can see the dates that they're reporting for, and the reporting date ends in December. And the first line here where it says current assets, that is things that can be turned into cash in the next 12 months. So cash and cash equivalents is anything that can be turned into cash immediately, like bank accounts or bonds that are going to expire in the next 90 days. This next line, receivables, is goods and services that have been delivered but haven't been paid for yet by the customer. This is money that will be coming in the next 12 months. Inventory is what they have purchased for goods and that are able for resale. These could be things like finished products or components. And once these things are sold from the inventory, it will actually be reduced and then added to the income statement under cost of revenue. When it comes to prepaid expenses here, you actually want to go over to the annual report of the company, which I'll show you how to do. And up in here in the right hand corner, you can go down here and scroll down to find, and then you can actually type in prepaid expenses. You don't have to type the whole thing out. There you go, see? And then you can just click and it'll bring you down through the 10K. And right here it says significant changes in the balance of contract assets. And that's how you find out what it is for that company, and it'll be different for every 10K you go through and every company you go through. So I just want to show you an example on Apple's balance sheet that they actually don't have prepaid expenses, but they do have deferred income taxes and other current assets. And you want to do that the same thing in going over to the 10K and looking for what those things are. So you can see Enphase here has other current assets, and you will want to go over to the 10K and do that and figure out what this number actually is. The next line we have here is non-current assets. This is a company's long-term investments where the value of these things won't be recognized for over a year. The next line down we have property, plant, and equipment. And this is essentially land, machinery, and buildings. And over time, that stuff is going to be depreciating in value, just like a car, for example. So these numbers in brackets are actually negative numbers. And so we're going to subtract 91 by 52, and that's where you get 39. So this is your net property plant. So that's what it's worth in the end. The next line down is goodwill. And this usually happens when one company acquires another. And let's say company A is going to buy company B. And company B is actually its assets and liabilities. Once you subtract the liabilities from the assets, it's only worth $8 million. But when you acquire a company, you're going to pay a premium. So let's say company A bought company B for 10 million and the company is only worth 8, then you paid $2 million over. And this is where goodwill comes in, because that $2 million that they overpaid for the company is because of things like patents or logos or brand names and just stuff like that. So it has to get added to the balance sheet. The next line down is intangible assets. And let's say you are a broadcasting company and you have the broadcast rights to a TV show, then that is the broadcast rights itself are the intangible asset because it's not a physical thing. Deferred income taxes is essentially the company overpaid in taxes and they're actually going to get that money back. So that's why it's a positive on the balance sheet. And this number is also not in Yahoo Finance. Other long-term assets can be things like pension benefits or restricted cash. And restricted cash is held onto the company for specific reasons. So you're going to have to go over to the 10K again and type in restricted cash in the find bar, and it'll show you in the 10K what it is. So at the bottom here, we're going to have the total non-current. So that's the non-current assets added up. And then at the bottom, we're going to have total assets here. And that's total current and total non-current all added up. And this is the total assets of the company. Now we're getting into liabilities. And this is what the company owes out of the business. So current liabilities is what they have to pay out in the next 12 months. So short-term debt is debt that they have to pay out in the next 12 months. This next line down under short-term debt is capital leases, and this is the interest they owe on land, property, or services. And let's say you took out a loan for $1,000 and it was 2%, well then you would be owing $20. So that's what the number represents, is the amount of interest that they are paying. Accounts payable is the money owed to the creditors for things like accounting services, legal services, supplies, and utilities. Accrued liabilities is an expense that has occurred but not yet paid for. So let's say Enphase goes out and gets a service and they don't pay it, and they're going to pay it later in the next 12 months. That's what this number represents. Accrued liabilities are services that have been provided for the company, but they haven't been paid for yet. So let's say like employees have worked and they haven't received their wages, or an interest on a loan hasn't been paid yet, or they owe taxes to the government and they haven't been paid yet. Deferred revenue refers to payments received from another company, and Enphase still has to provide that service, which they haven't provided yet. So this is a liability because if Enphase doesn't provide that service, they're going to owe that money back. The next line down, other current liabilities, these things are smaller debts and they kind of just get pooled together because they actually aren't big enough to have their own line on the balance sheet. So at the bottom here, we have total current liabilities, and these are just the numbers that are all added up together. Now we have non-current liabilities, and this will be the liabilities that have to be paid over a year. So we have long-term debt, and you can actually go on the 10K and they will describe a little bit about what kind of long-term debt they have and when it has to be paid off. Next line down, accrued liabilities. This is the same as the current liabilities, accrued liabilities, but except it's longer than 12 months. Deferred revenue and other long-term liabilities is the same as the section in the current liabilities, but just longer than 12 months. Preferred stock and common stock I wouldn't pay too much attention to, but retained earnings is the big number here. And what retained earnings is the profits that they are pretty much making and retaining. And you can see here 346 million goes down to 185. So that's actually a trend moving upwards, even though these numbers are negative. That's why they're in brackets. The brackets means negative. So what we want to look for is a company that is able to keep retaining earnings every year, because this is an accumulated number. It's not just what they did that year. It's added up over the years. And when a company is generally has positive retained earnings, they can use that money for things like dividends. Total stockholder equity is essentially the money that would be returned to the shareholders if the company was liquidated. So if they took all their liabilities here on total liabilities and subtracted it from total assets, that's how you get stockholders equity. And this is what we're giving back to the shareholders. So we're going to get into a calculation here, and what you want to look at is the total liabilities compared to the total assets, because if total liabilities is higher than total assets, that's a bad sign for a company. But for example here, 441 is lower than total assets, so that's a good thing. And it's actually it's about one and a half times. So they have 1.5 times more assets than they do have liabilities, which is a good signal. So that was showing the health of the company in the long term past a year. So now you can do the same thing with total current liabilities, which is 199, and then total current assets is 500. So that can go into their like 2.5 times. So that's a very healthy company in the short term. The most important number for me on the balance sheet is cash. And you want cash to be higher than the debt. You almost want to be twice as much, because a company with cash can essentially pay off all that long-term debt if anything were to happen to the company where they had to stop making revenue. Having a lot of cash as well is a good sign of how well the management can use that cash, whether it be acquiring another company or putting it into a new technology. So having cash can be really important on growing the business, because if they can invest that cash properly, they will be able to grow the revenue and then grow that cash position to keep reinvesting. Now it's time for Warren Buffett's favorite calculation, which is return on equity. My favorite thing about this number, it has nothing to do with the stock price. Shareholder equity is the money that individual investors have given the company, and with this calculation we will see how management is able to invest it and make a return on it, therefore making us more money. The calculation is, you have to go over to the income statement and grab the net income number, and you're going to divide that by the shareholders' equity. So if net income is negative, you actually can't make this calculation because there are no profits. So you're not getting a return on your equity that you're investing into the business. So we're going to use a company like Apple, and we're going to go over to the income statement. So if you scroll down here, we can see they have 14 billion here in 2010. And we don't need to use the whole number, we're just going to use 14. And then we're going to go down to the balance sheet where it says stockholders' equity, and we can use that number 47. So let's punch that into the calculator. 14 divided by 47, and it's going to give us a percent. The percentage is the last two digits after the decimal. So, and if you round the 7 up, you can get 30. So they were able to have 30% return on equity. So that's the return on the money that you're investing into the company, which is really good. And then what you want to do is keep doing the years ahead. So I'll do one more, and then we'll move a couple of years ahead. So if we go to the income statement, go back to net income, which here it's 25 billion here in 2011. So we'll take, well, 26 because of that 9. So we'll take 26 and we'll divide that by 76. So put this here in the calculator, 26 divided by 76. So we get a 34% return on our equity, which is really good as well. So now let's head to 2019 and we'll pull that number off the income statement. So they have 55 billion in net income. So let's over to the balance sheet, and on the balance sheet we have 90 billion for stockholders' equity. So 55 divided by 90, boom, 61% return on equity. So you'd want to do that for all these lines to see how well management is being efficient with the money. So that's a really, really good calculation.
Thank you so much for watching my video. If you found this information useful, hit the like button, subscribe if you want more content, and I'll see you in the next one.